Hello everyone, here is a review exercise for your comprehensive assignment number 2. In this exercise we're going to be Portnoy drumsticks, and we sell only two models of sticks, the 2A rock stick and the 7B jazz stick. We purchase all of our sticks directly from an outsourced manufacturer named Hickory Sticks, and Hickory Sticks does not offer us any credit terms on our purchases. So they don't say, hey, if you pay us within 10 days we'll give you a percentage off. We have to pay full every single time. We're going to value our inventory using the Fifo method, first in, first out, which means that we always assume every time we make a sale it is the oldest piece of inventory that we have of that type in our wares. That's how we are going to assume the cost flow of our inventory as it goes through. We're also going to abide by the GAAP Conservatism Principle that says first we need to record all of our purchases at their gross or full value. That's not a problem for us because we don't get discount terms anyway. But it is going to matter for our sales to our customers because we're going to record them net of the discount. Every time we make a sale, we assume that customer is going to pay within the discount period at the time we record the transaction. During this period of November 20XX, we sold our two respective models for the following prices. Every time we sell a pair of 2A rock sticks, we sold them for $10 a pair. Every time we sold a pair of 7B jazz sticks, we sold that for $8 a pair. And in beginning inventory, we started with some, which was 80 pairs of rock sticks, which had a cost basis of $4. That's what we paid to acquire them per pair. And we had 100 pairs of 7B jazz sticks, which we paid $3 a piece for. As we're going through this month, as we're doing all of these transactions that you see down here, we're going to have to record not only our revenues, but our cost of goods sold. How are we going to know what to record for cost of goods sold? We have to keep a running record of our inventory every time we have a transaction. We're going to have to keep a perpetual inventory record for both of our two types of inventory, the 2A rock sticks and the 7B jazz sticks. And there is a template for that right here. And since we know the beginning balance of our two respective types of inventory, we might as well start our perpetual inventory records. So for the 2A rock sticks, what are we beginning the period with? What's going to go into our quantity of our inventory on hand? Well, according to our information, we're starting with 80 pairs of those. Each pair of 2A rock sticks that we have when the period begins, we paid originally $4 a piece to acquire. Well, to figure out what our total cost is, we just multiply quantity by unit cost. And we can do that in Excel by hitting equals, clicking the cell with the quantity, multiply by clicking the cell with the unit cost. 8 times 4 is $320. Also in Excel, if we want to put a line in our perpetual inventory record so we don't get confused, we can make sure we know when a transaction has been finished being recorded. We can throw a line underneath using the border function, which is this guy right here. And if you click this little arrow, there's a whole bunch of different options where you want the border, etc. The top one, bottom border, is sufficient for this. If we click that and we have everything highlighted, it's going to put a line underneath. So we know that we are done recording that specific layer of inventory. We threw our 2A rock sticks in. Let's throw our 7B jazz sticks into our perpetual inventory record as well. Information tells us we're starting with 100 pairs at $3 a piece. So in our inventory on hand section, we can just hit enters, click on information, go grab our quantity of 100. Do the same thing to go grab our unit cost of our beginning inventory, which was $3 a piece. And if we multiply that out, that means that we have $300 of 7B jazz sticks when we started the period. Let's highlight this whole line again. Again, go to our drop-down list and pick bottom border. And we have our perpetual inventory records started, which means we can start recording our transactions. And in our first transaction on November 2nd, we sold 30 pairs of jazz sticks to A&J Drum Center. Well, we know that every time we make a sale as a retailer, it requires two entries. The first one records the revenue, and the second one records the expense. Let's start by going to our journal and recording in our entry to record the revenue. And again, this is happening on November 2nd. According to our information, we sold 30 pairs of jazz sticks to A&J Drum Center, and we offer them credit terms of $310 net 60. So they get 3% off if they pay within 10 days, and they owe us the full balance within 60 days. Well, since we're offering them credit terms, it's assumed that this sale is on account. And whenever you make a sale on account, the journal entry to record the revenue portion of that transaction is always the same. It is a receivable for the amount that you're recording at the time of sale. And our information up here tells us that when we record the necessary journal entries to account for our inventory related transactions during the month, we're to use a separate sub-account for each vendor or customer when we record our payables and receivables respectively. What do I mean by that? It means that since we're selling to A&J Drum Center, we should make a specific receivable account just for them. So I'm going to call it AR A&J Drum. And that is an asset account going up. And the entry to record the revenue on any transaction always has a credit to sales revenue. And what we did is we sold inventory to A&J Drum Center with terms of $310 net 60. Now we got to figure out how much revenue we get to record. So we can figure that out by going back to our information page. We sold them 30 pairs of 7B jazz sticks. We sold them 30 pairs of jazz sticks. And those 7B jazz sticks we're selling, according to our information, for $8 a piece. So if we click on the 8 right there, multiply it by the 30 pairs, we get the full price that we would, be charging them for this particular sale. But we are using the Conservatism Principle, where we record our sales at discounted value. And what I mean by that is we have to assume at the time we're making a sale that they're going to pay within these 10 days and get 3% off. So if you took 30 and multiplied it by the 8, that should be $240 that we're getting. But we're going to assume that they're not going to pay that full $240 because they're going to get 3% off. So let's multiply this one more time by the portion we expect to receive. If they're going to get 3% off, that means we're going to collect 97% of that. So our $8 times the 30 pairs that we are buying times 97%, the portion we expect to get after they receive their discount, is going to come out to $232.80 worth of revenue we get to receive. We know our debits equal our credits, so we can just bring that on over. And that's our journal entry to record the revenue portion of it. Now, we're going to need to see another journal entry on the same date to record the expense portion. And on the sale, as you know from Chapter 5, it's always the same entry. There's a debit to cost of goods sold, your expense account going up, and a credit to merchandise inventory, your asset account going down, and an entry that records the cost of goods sold on your sale. What's our cost of goods sold going to be? Again, that depends on what method we're using. And if we go up here, we see we are using the Fifo method. We assume we sell the oldest piece of inventory first. So now we have to go to our perpetual inventory record for the particular type of stick we're selling, which is the 7B jazz stick, and figure out how much this is going to cost. Well, our 7B jazz sticks down here only have one layer of inventory. So conveniently enough, on November 2nd, when we record this, we don't have to worry about which layer we're grabbing from because we only have one layer. So we're going to take all 30 of those sticks from our beginning inventory layer, and our beginning inventory layer had a unit cost of $3 a piece, which means that our cost of goods sold on that transaction must be $90. And now we need to adjust our inventory on hand. What do we have left? Well, we had 100 pairs of these 7B jazz sticks, but we sold 30 of them, which means there's 70 left. Those 70 are still being carried at a unit cost of $3 a piece, which means if we want to figure out the total cost of our inventory on hand, we again take our quantity and multiply it by our unit cost. We come up with $210. So what are we going to record COGS for? We have it right here. It was the total cost of our cost of goods sold in that transaction. So if we go back to our journal, we're going to record our cost of goods sold by hitting equals, going back to our perpetual inventory record, and taking the total cost of that transaction, which was 90. It's also the amount that our inventory went down by, and we can see that here. Did it decrease by $90? It sure did. It went from 300 down to 210. So that is both of the entries to record our sale. Done with the first transaction, we can move on to the second transaction. In our second transaction, we purchased an additional 50 pairs of 7B jazz sticks from Hickory Sticks, and we did so at a price of $3.25 per pair. Again, Hickory doesn't give us any terms, so we don't have to worry about any of that stuff. We just got to throw this into our perpetual inventory record to figure out what is the cost of this purchase. Well, we can go throw a line underneath this because we're starting a new transaction here for our 7B sticks. And on November 5th, we are going to purchase, one more time, double check our information, 50 pairs of 7B sticks at $3.25 a pair. So 50 is our quantity of our purchase. Our unit cost is $3.25, which means that our total cost is going to be equal to $162.50. That's what we're paying. We're using the Fifo method, which means we need to layer. We can't just merge all our inventory together. We need to know what's our oldest layer, what's our newest layer, because we're always assuming that we're selling the oldest layer first. So what we're going to do is bring down what we had. We had 70 pairs in inventory that had a cost of $3 a piece before this transaction. In Excel, there's this fancy little thing called the fill handle, and if you take it and you drag it over, it's going to copy the cell. So here in this particular guy, I had it equal cell H25, and as you can see, that was the 70 that I clicked on above. Well, if I drag this with the fill handle one spot to the right, it's going to bring over cell I25, which is fine because I want to bring down that $3 a piece. And then if I drag it over one more time, it's going to bring down that 210. What happened to my decimals? That happens sometimes, but it's easy enough to fix in Excel. If you want to change your formatting, that's this number section right here. And the one that you want is this guy on the end that's a comma style. So if we click on him, it's going to put our decimal places back in. So that was bringing down our prior layer. Now we want to make a new layer for what we just purchased. Well, we purchased 50 units. That same thing that we just did before with the fill handle. Again, this is equal to cell B26. When I slide it over one to the right, it's going to slide the cell it's referencing over one to the right. So if I drag this over twice, it's just going to grab the 325 and the 162.50. Why did it come out to 3 and 163? Because again, it's not showing the whole number. But we can go and we can click comma style, and there we go. They're all back in again. We got two decimal places. If for some reason you wanted to do it another way, these guys on the side over here are your increase and decrease decimal buttons. So if I wanted to throw a bunch of zeros in there, I could. If I got too many, I can bring it back down to two decimals that way. But we're good. That's what we want this particular transaction to look like. So let's go and put a bottom border on it. So now we made our purchase, and it cost $162.50. Our perpetual inventory record tells us that, but we don't have it in our journal yet, and that's a problem. This is happening on November 5th. And again, the amount of what we are grabbing, according to our perpetual inventory record, is $162.50. That was the total cost of our purchase. Well, what do we do when we make a purchase? We debit merchandise inventory, because we're buying more inventory. The value of that asset account has to be going up. And since this is on account, even though we're not getting any terms, we have to have a credit to accounts payable. We are again using subsidiary accounts, one for each company that we are buying from, to keep track of stuff. So who are we buying this from? Our information tells us we're buying it from Hickory Sticks. I'm going to abbreviate it to AP Hickory. A liability account increasing because we owe them more money. And the amount of inventory, and subsequently the amount of payable we're going to have to put on the books, is equal to whatever we just put in our perpetual inventory record. And here we purchased inventory on account, and we did so with no terms. Two transactions down. Moving on to our third transaction, where we purchased an additional 20 pairs of 2A rock sticks from Hickory Sticks at a price of $4.20 per pair. Well, we can go to our perpetual inventory record and throw that in as well. This time we are buying 2A rock sticks, so let's not go on autopilot and put it in the table for our 7B jazz sticks. We got to go up to our 2A rock stick table. We are making a purchase, and again, that purchase is on November 6th. And on November 6th, what are we buying according to our information? We are buying 20 pairs at $4.20 per pair. Let's put that in the purchases section. We're buying 20 pairs. We're doing so at $4.20 per pair. So we can figure out the total cost of that purchase by multiplying our quantity times our unit cost, which was $84. That's how much we are paying for this transaction. Let's go and let's bring down the layer that we had before, because we have to layer our inventory under FIFO. And then we can use that fill handle, again dragging on the little box in the corner to bring this over. And let's go and bring over the layer that we just purchased. And again, we can fill handle with that as well. And then we can get our, we can get our decimals back up to snuff here. There we go. And lastly, we can throw a line underneath. So now we know this purchase cost us $84. After we made this purchase, we have a total of 100 rock sticks in inventory, but 80 of those are our oldest layer at a unit cost of $4 a piece, while the last 20 are the ones we just purchased. They have a unit cost of $4.20. We have our numbers, our perpetual inventory records good. Let's make sure that our journal looks the same way. So on 11/6, we're going to make the same entry that we did above. We are going to have a debit to merchandise inventory and a credit. We only have one vendor, thankfully, to AP Hickory, for a transaction in which we purchased inventory on account with no terms. How much was the inventory value that we purchased? Well, we just figured that out. It was $84. So we can go and we can bring that number down. And our debits have to equal our credits, so we can say equals and grab that debit number as well. $84 a piece. 3 transactions down. Moving on down the line. On November 9th, I should say, we received payment from A&J Drum Center for the November 2nd sale. Well, when we receive payment, we got to look and see, are they paying within the discount period? Because every time we make a sale, we assume that they are. This is for the November 2nd sale. They had 10 days to pay us to get 3% off. Well, they're paying us on November 9th, which is less than 10 days from the time that we made the sale. So they are getting a 3% discount. But that's okay, because we assumed that was going to happen at the time that we made the sale, and we recorded it net of the discount, which means now we can collect it for the amount we thought we were going to receive and put a receivable on the books. What do we do with the perpetual inventory record in this case? Absolutely nothing, because no inventory is moving hand in this transaction. We already sold the inventory beforehand. They're not returning any to us. We're not purchasing any additional inventory. So for a sale, for the collection of a previous sale, I should say, we don't have to adjust our perpetual inventory records. So all we got to do is go to our journal, and on November 9th, we can throw in a journal entry that records the receipt of payment from A&J Drum Center. Well, we're receiving payment. So what's going to be our debit? If we're getting paid, I hope we're getting cash, and because cash is an asset, and like all assets, it goes up on the debit side, we want to debit cash. What's got to come off the books? That receivable that we had from A&J Drum Center, because they're no longer going to owe us because they're paying us in full. So what do we do here? Well, up here on November 2nd, when we made the entry to record the revenue, we assumed they were going to pay within 10 days and get 3% off. And again, this is only 7 days later, so they did. So how much cash are they actually sending us? The amount that we assumed earlier. Since they're paying within the discount period, we can just straight bring down the number that they had, because they're going to be paying us exactly what we proposed when we recorded that sale net of discount. So in this case, we receive payment from A&J within the discount period. Next up, we have November 12th, where we sold 60 pairs of rock sticks to Blast Beat Music Supply. Now we're making a sale, which means inventory is flowing out of our business and into our customers' hands, which means we need to record that flow of inventory on our perpetual inventory record. So let's go back over here. We're selling 60 pairs of rock sticks. So we go up to our rock stick section. Well, we're selling 60 pairs, and we're using FIFO, which means we always assume that the oldest units that we have in inventory are the first units to be sold. What are the oldest units that we have in inventory related to these rock sticks over here? And the ones that we started the period with, right? If we're selling the oldest ones first, we're going to assume that we're selling from, in this case, our oldest layer, which is our beginning inventory. Do we have enough units in that layer to cover this whole sale? Yeah, we're selling 66. We had $84 sticks, so we can assume that all 60 of these are $4 sticks. And then we're going to multiply this to figure out that our cost of goods sold on that sale is going to be $240. What is going to be our inventory layers afterwards? We had $84 sticks, but we're selling 60 of them, which means now 80 minus 60, we've got 20 left. Those are, again, $4 sticks, and we can go and we can multiply that to figure out that we still have a total of $80 worth of 2A rock sticks that we had in beginning inventory. We also had 20 sticks that cost $4.20 a piece, and we didn't sell any of those, so we can just bring down that whole layer of inventory. We still have all 20 of those $4.20 sticks. So let's go and let's move our decimal over. So we got 2 decimals again. And since we were done with that transaction, now we took the units that we sold out of inventory. Let's throw an underline underneath it. Updated our perpetual inventory record. Now we need to record it in our journal entries. Again, always 2 entries when you make a sale. So 11/12, we're going to have one that records the revenue and one that records the expense. The one that records the revenue always starts with a debits to your receivable account for the, in this case, subsidiary account of the company we're selling to. And we are selling to Blast Beat Music Supply. So in our journal entry, we can just call this account AR Blast Beat. And the credit is always going to be to sales revenue in a transaction where you sold inventory on account and we gave our customer terms of 310 net 30. So what amount of revenue are we going to receive? Let's hit equals in the cell and then go back to our information. We are selling 60 pairs of rock sticks, and our information tells us that each rock stick we sell has a unit sales price of $10. So if we sold all 60 of those at $10 a piece, that would be $600 that we would get for the sale. But we're assuming they're going to get their discount. They're going to get their 3% off. So let's multiply that again by 0.97 because we think we're only going to see 97% of that full price. And when we do that, we get $582 is what we are expecting Blast Beat to send us within the next 10 days when they pay in time to get their discount. And that's also the amount of revenue that we are going to record. So that's the entry to record the revenues. Let's do the entry to record the expense. It is always exactly the same. It is a debit to cost of goods sold, expense account increasing, and a credit to merchandise inventory, if I could spell it correctly, for the amount that your inventory account is going down by. So what do we have here? Well, we got that number on our perpetual inventory record. When we made the sale of our 2A rock sticks on 11/12, excuse me, I forgot to put the date in, tisk, on 11/12, we said that we were selling all 60 of those, assumedly, from our beginning inventory. So they're at $4 a piece, which means our total cost of goods sold was $240. So that is what we're going to record this particular sales cost of goods sold as $240. And debits equal credits. Let's bring that over to a credit to merchandise inventory. And once again, we recorded COGS on sale.